What's up everybody, Gen X Dividend Investor here. In this important video I explain why your dividend portfolio needs goals in order to best enable your needs and dreams. And before you keep watching this video, please hit pause and then leave me a comment telling me why you invest in dividend stocks or why you're planning to invest if you haven't started yet. Go ahead, pause it and tell me. Okay, I'd imagine that many people invest in order to have a better retirement. Some folks are looking for another source of passive income cash flow, and others probably build up their portfolio in hopes of using it in the future for something big, like a down payment on a house or something. But whether you're investing to grow your net worth, or you're just trying to defer or avoid taxes or whatever, I'd recommend you create specific portfolio goals to be achieved, ideally within set time horizons. If you don't set goals, then there's a higher likelihood of your portfolio going in multiple directions in a way that could hurt you long term. Ultimately, your goals should be aligned to whatever future state you envision for yourself. Picturing what you want your future to look like, a vision of where you'll get to, is a great way to both motivate you and keep you focused on what you do and don't do, and setting achievable, time-boxed goals aligned to your desired future state helps keep you oriented along the way. Like when I was 21, I had a goal of retiring before I hit 50, but at the time I had no idea how I'd do that. I figured I'd just have to work and save cash in the bank, maybe $1 million, because $1 million always felt like a good target. I had a salary of $30,000 a year at my first job, and I realized that only putting cash in the bank would probably never grow my wealth fast enough to take me to that $1 million that I wanted before 50, so I focused instead on getting $1 million net worth before 50. But I was still hazy on what assets would take me there. Maybe I'd start a business, or maybe I'd invest in real estate, or God knows what. Fortunately, a coworker convinced me to start investing in stocks, and so I opened my work 401k and gave myself a goal to open a brokerage account. Now, opening a brokerage account probably seems like a lame goal to have these days because the internet has made things so easy, but until the late 90s, Google didn't even exist, and most people didn't even have an email address. That meant that you had to learn about stocks through word of mouth or from talking to a broker or from your high school econ class or maybe from the local library. Those days we checked ticker prices in newspapers, though slowly over time we saw stock information making it on the web. Originally we'd place our buys and sells with a broker after calling them on the phone, and Schwab charged something like $30 a trade. E-Trade was slowly growing online, though it was still like $20 a trade in the beginning, and then as more and more things transitioned to the web, the increased competition helped keep pushing fees down. Like in the early 2000s, E-Trade dropped its fees to $11 a trade, and then a little more than a decade later we got to the point where places like Robinhood opened, and that really started the arms race of no-fee trading. Anyway, when I started with stocks, I figured my retirement account was for buy and hold investing, and my taxable account would be for buy low, sell high stuff. Retirement sounded like utopia for me, a life where I'd not have to deal with annoying work issues or sit in traffic for hours, and instead I could just enjoy my time playing video games, reading books, watching movies, working out and hanging out with friends and family. The goal for my portfolio was to grow and to grow fast, so I put my money mostly in high-flying tech stocks as the internet age was blossoming, and I got greedier as everything kept shooting up, and I chased riskier and riskier tickers. Neuroscience has shown us that quick, easy money makes us feel good. Unfortunately, behavioral economics tells us that acting on impulses, like quickly deciding to buy a new stock in hopes of turning a quick profit, tends to not end well. I remember wondering if it even made sense to hold boring Dow companies, since they weren't moving like the micro-crap tech stocks were. Did I say micro-crap or micro-cap? Well, it was true either way, and while I did hold some quality companies, I also owned a bunch of not-so-hot stuff. And sure enough, the bad stuff plummeted when the dot-com bomb hit and my tech-heavy portfolio got crushed. And while I really wanted to run away and never invest again, my goal of building my assets to $1 million before 50 helped me not to quit. That thought of retirement utopia pushed me to keep investing even though the last thing I wanted to do was think of stocks. The dot-com battle wounds helped change my perspective to instead focus on well-established blue-chip companies as I saw how they held up better than market crashes. And that's when I really started to focus more on dividend-paying stocks. At the time, I didn't even realize how motivating it could be to have your dividend stocks configured to automatically reinvest into themselves in a retirement account, something that would make your share count and income almost invariably trend up. And seeing that happen, even when stock prices tanked, was something that helped keep me in the game. That negative investing experience taught me that I had been too focused on the short term and wasn't thinking enough about how I was still multiple decades away from 50, and that small wins over a long period of time would have a much higher likelihood of getting me where I wanted to go. That reminds me of this college friend of mine who's about 50 years old and who's told me he plans to work until he's in his 70s, basically as long as he can, because retiring early doesn't seem possible. I've talked to him about investing in quality stocks as well as how a dividend investing strategy can work, and he'd never really thought about dividends, but he felt like it was too late for him to start investing. I told him it's never too late and even small amounts of investing can add up. Then fast forward to last week and my friend tells me that he and his wife just inherited $150,000 from a relative who died, and he decided to take $100,000 of it and buy a new sports car. I suggested that maybe he should invest it and keep driving his old car, but he said that $100K wouldn't make enough of a dent in his retirement needs for him to want to do that, and he was still 20 years away from ever retiring, so why not just have some fun with the money? His mindset of spending cash rather than prioritizing it for investing is pretty normal for most people out there, even those that truly have spare cash. Let's quickly take a look at how a $100K investment by him could grow over time, as well as help enable a retirement goal. Let's say he creates a portfolio that has a starting yield of 3% along with a 6% dividend CAGR, and let's say inflation is about 3% a year. Now, these days even saving cash in a money market or CD can be good, and everything has its pros and cons. Okay, and what we see is that in the first year, his portfolio would yield $3,000 of passive income. By year 20, assuming he was spending that dividend income as it came in, his inflation-adjusted buying power would be $5,200 of passive income a year. At that point, he'd be like 70 years old, and over those 20 years, his portfolio would have grown from 100K up to 310K, and it would have yielded him 98 grand of extra income over those 20 years, adjusted for inflation. Note, if his 100K had been in a retirement account and he was reinvesting rather than spending the dividends, then his portfolio would be worth 476K, and it would be dripping over 8K per year, adjusted for inflation, or about a $500,000 portfolio yielding 16K per year if you assume no inflation. The key point in all this is that you want to start with a financial plan to enable your vision of where you want to go, and create goals to achieve your vision. If you don't need portfolio income and you're just focused on growing your portfolio as much as possible, then you should invest in assets which do just that. A younger person generally wants to be focused on growth more than anything else, and that growth can come from both dividend stocks and non-dividend stocks, and/or from ETFs. In my experience, you tend to see more stock appreciation from stocks with lower dividend yields, along with those that have higher dividend CAGRs. And if your goal is growing your portfolio size, then invest in whatever companies you think will have the best growth, regardless if they have a dividend or not. A classic low-yielding ETF like VTI or VU is probably the smartest thing to invest in over the long run if your goal is growth. I'd also bet that companies like Microsoft, which I have in my account and my kids' accounts, will be a great growth stock over the long run. My kids like the fact that Microsoft has a big video game division, so that acts as a motivator for them to invest in it. And then on the flip side of growth-oriented stocks are ones that are better for income, like Altria, which are more aligned to my goals of income, though they obviously have their own risks to be aware of. Another portfolio goal to consider might be to decrease the overall risk of your portfolio, and one way to accomplish that might be to increase the number of stocks you hold. Like if you only have 5 tickers, then growing your portfolio to 20 or 30 tickers is probably a good long-term strategy aligned to a risk reduction goal. And then along with managing risk better, maybe you have a goal to lighten some sector concentrations you have as well as increase others. Like I'm a bit too heavy in sin stocks, so I plan to decrease that, probably by gradually increasing my positions in other sectors rather than selling any sin. I'm currently light in financials, industrials, and materials, so they're all places I'd give a hard look. Or maybe your income is too concentrated in certain tickers, so you might have a goal to address that. Another way you might choose to manage the risk in your portfolio could be to ensure that you own at least 2 tickers in each of the 11 sectors out there, giving you better coverage. Or you might have a goal to invest more internationally, or perhaps to invest into other asset classes beyond stocks. Or maybe you have a goal of increasing the dividend CAGR of your portfolio, so you focus on tickers with over 10% annualized dividend growth rates. Another common goal is to invest until you have a certain number of shares of a specific stock. Like maybe you want to own 100 shares due to some plans you have with options, or simply 100 is a nice round number that you want to get to, kind of like you might want to set a goal to bench 225 or whatever. Or maybe you want to get to a point where you have enough of a particular dividend stock such that it buys at least 1 share of itself every payout. Like let's look at Realty Income. It's unfortunately been going up in the last week. Unfortunate because I want to DCA a bit into it and I'd rather the prices go down rather than up. But I feel it's still cheap, so I'm fine buying it. And we see it's at $50.70. So how many shares of O would you need such that each month it dripped at least 1 share? Well, you'd need your O position to yield at least $50.70 a month, which is $608.40 a year. Seeking Alpha says that each share of O pays out $3.07 a year. So 608 divided by 307 equals 198 shares of O would be needed to drip 1 share per month. And for reference, 198 shares of O would cost about 10 grand. That means if you had around 198 shares of O, then every month your drip could buy another share, assuming the price stayed steady. And that reminds me of something my friend Pierre at PK Investing once said, and literally as I was working on this part of the video, I got a notification that Pierre had just left a new comment on one of my videos where he said that his BHAG, or Big Hairy Audacious goal, was to be able to generate enough dividend income that he could quit his job and become a stay-at-home husband. What Pierre once said was a dividend term he coined called PSR, which stands for Pierre Sustainability Ratio, which is a ratio that shows how many shares you drip at each dividend payout. And here's Pierre on a thumbnail of a video I used. So if you owned 198 shares of O, then your PSR would be 1. Now I don't advocate that anyone should arbitrarily push for a PSR of 1 in each stock they own, but it is fun when your positions are dripping full shares each quarter or each month. And you might be the type of person that needs motivation to stay true to your investing, because doing anything for decades isn't easy. People often need goals to ensure they keep moving forward. A classic goal might be how much you want to inject into your portfolio each month or paycheck or whatever. Like you might plan to invest $40 every 2 weeks, and you prioritize things to make that happen, sacrificing expenses you could avoid if need be. The key point is to understand yourself and then create a plan to achieve your goals. Jordan Peterson was recently talking to Dave Ramsey, and he said that one cause of poverty is absence of a plan. He continued on saying, you need to develop a vision for your life, and that makes delaying gratification and not engaging in impulsive momentary pleasure worthwhile, because you're building towards something you actually want to attain. We are very bad in our society, appallingly and miraculously bad at helping people develop a vision. It's a miracle of stupidity, he said. Peterson continues on saying, it's the number one thing we should be teaching people and we don't do it at all. Who do you want to be and why? What do you want your life to look like in 5 years? What are you building towards? Why are you saving or working? What's your vision and what makes it worthwhile? When you see yourself moving towards a goal, then you're inspired. You have hope, you have enthusiasm, you have energy. You can communicate effectively and enthusiastically. No goal, you have none of that. No vision, no goal. And regardless of what you think about Jordan Peterson or Dave Ramsey, I think the advice is sound. Realistic goals can frame how much you plan to invest, how risky those investments are, etc. The reality is that most of us don't have wealthy parents who leave us a nice inheritance, so we gotta figure out how we can eventually retire, ideally on something other than just Social Security or a pension or whatever. And speaking of inheritances, one of the goals of my portfolio is to make it easy to run on autopilot without my family needing to know much about stocks, yet still be able to get cash flow out of it, which is a key reason why I've been going heavier into SCHD. Maybe you're planning to have kids, or you just had kids, so you open 529s or meet with an estate lawyer or whatever. Your actions you take should be aligned to wherever you want to take things. Now, I've always been someone who likes to see my goals in front of my face, in notes on my computer, desktop, or phone, things that I update as time goes on, as well as refer to every so often. Some people like to write down an investment thesis to help guide them. Writing things down is a great way to clearly articulate your goals, as well as to track your progress towards achieving them. Some people like using financial advisors to help them with their goal setting, as well as to keep them on track. Kind of like some people in the gym like to work out with a trainer, and others are fine to figure things out on their own. But be the person who has a plan, who works specific muscles, who learns how to train, how to eat, how to rest. Don't be the person who just meanders around at the gym, not focus on what they're trying to accomplish. And be careful if you find yourself changing your goals too frequently before achieving them. Like, don't be the person who starts with blue chip dividend stocks and then switches to SPACs and then switches to crypto and then goes all in on Tesla and then. Sometimes it will make sense to change, just like new things happen in life, or big things can change the market. Whatever you do, just realize you'll sometimes make mistakes, and that's normal and that's okay. Back to the lifting analogy, sometimes you'll get sick and your lifting will suffer. Sometimes you'll injure yourself. Sometimes you'll buy a stock right before it plummets, and sometimes you'll sell it the day before it shoots up. That's life, unfortunately. Don't quit, just keep moving forward. The fact that you're learning and trying already puts you in a small minority of intelligent investors in the world. And if you made it this far in my video, then I kindly ask you to hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. My last video showed me that my thumbs up metrics didn't change too much by only asking at the end, so I'll keep doing that. Finally, I'd like to thank Seeking Alpha who sponsors me. Consider using my affiliate link in the description of this video, as using it often comes with benefits for new member signups. And I highly recommend that you join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 76 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.